Good morning, everybody. Today, we will discuss about Phar-Mor Incorporated, case study analysis and discussion. Phar-Mor Incorporated was a company that based on chain of discount drugstores, started in 1982, located in Youngstown State, Ohio. The founder was Michael I. Monas, or Mickey Monas, and David S. Safira in 1982. The other business was Giant Eagle, supermarket chain headquartered in Pittsburgh. Giant Eagle was also the largest Phar-Mor stockholder that had 50% of the ownership. The company background. Phar-Mor had a massive growth within a decade, from a single store in Niles, Ohio to 300 stores, employing 23,000 employees and achieving sales of $3 billion. The stores were warehouse size and sold everything from prescription drugs to office furniture, electronics, sportswear, and videotapes. The fraud appeared two versions of monthly financial reports. Patrick Finn, the CFO, the first statement, true report, staggering losses. Second statement, David's report, ever increasing profit. The Coopers and Lybrand was Jeff Wally and Stan Silstein. The auditor, including Vice President for Finance and Controller. Therefore, it appeared conflict of interest because the accounting firm was not independent in their duty. Check writing machine with Monas sign used to move Phar-Mor's fund to WBL and elsewhere. So this is also the weakness of control, because check writing machine was prohibited from the point of view internal control. Overstate financial statement. Overstate income in 1989, 1990, and 1991. In 1991, income reported as $50 million profit, while the truth was $150 million loss. The source was form of improper accounting for large initial payment from big vendors such as Coca-Cola, Fujifilm. The total value was $140 million. Why did Phar-Mor make overstate financial statement? Number one, maximize executive bonuses based on reported profits. 2. Phar-Mor looked good to investors and potential investor. Image building. Discovery of the fraud. The fraud was investigated by Federal Bureau of Investigation (FBI), and Internal Revenue Service. In 1992, Phar-Mor took a $350 million charge. Michael Imonus replaced by David Safira. Coopers and Lybrand was replaced by Deloitte and Touch as the independent auditor. In 1993, Monus was indicted 129 counts of fraud, including filing false income tax return and money laundering. The legal action: Phar-Mor accused Cooper about the unexplained inventory adjustment. Cooper's taking only 5 to 10 stores in physical inventory audits. So this is related to insufficient audit samples. So the auditor cannot conclude sufficient audit conclusions for everything relating to physical inventory audits because the sample was limited. August 1992, Phar-Mor filed for bankruptcy protection under Chapter 11 of U.S. Bankruptcy Code. Phar-Mor closed 132 of 300 stores, downsized 13,000 employees. Chapter 7 or 11 in bankruptcy. When a business was unable to service its debt or pay its creditors, the business or its creditors can file with a federal bankruptcy court for protection under either Chapter 7 or Chapter 11. In Chapter 7, the business ceases operation, a trustee sells all of its assets, then distributes the proceeds to its creditors. Any residual amount is returned to the owners of the company. In Chapter 11, most instances, debtor remains in control of its business operation as a debtor in possession and is subject to the oversight and jurisdiction of the court. Reorganize. In February 1993, Antonia Alvarez, turnaround specialist, hired as president and CEO. April 1993. Phar-Mor gained $200 million in cash from operation. Negotiated a $150 million debtor financing agreement. And then accounting and reporting had been greatly improved. Planning for POS point of sale scanners for better inventory control. Case analysis. 1. Inadequate business strategy and high pressure competition. Deep discount retail chain 25% to 40% off retail prices. Lean margin with high volume. Competition intensified 1985 until 1990. 313 to 700 stores. Phar-Mor had 300 stores. Aggressive pricing and offer expansion started losing money. 2. The hands-off management style of David Safira. Modest living style. World Basketball League WBL became tumbling. Channel money to WBL and unrelated check paying to Phar-Mor signed by Monas. 3. Collusion among upper management. CEO Michael Monas and CFO Patrick Finn, Vice President for Finance Jeff Woolley, and Controller Sil Stein cooked the books. Jeff and Sil Stein were former staff members of Coopers and Lybrand. 2 books were created, Monas' loss and Safira's profit purposes. Monas sold over $900,000 worth of services to Coopers and Lybrand from 23 persons, either relatives or friends. Questionable auditors' independence, integrity, and objectivity. Destroy internal control system. 4. Poor internal control. Bypass AP by a supply or bank checks on 2 different bank accounts. Those involved in the fraud authorized to approve the checks. Check writing machine with Monas signature. 5. The weaknesses of accounting and operational assurance. Gross profit deteriorated in margins. Unexpected $5 million pre-tax loss. Inventory shortage from Tamco. Partial delivery, fully billing. Calculated formal analysis estimated $4 million. Negotiated Phar-Mor to Tamco resulted $7 million settlement. Resulted pre-tax profit approximately $2 million in 1988. Lack of adequate management information system. Inventory $11 million 1989 to $36 million 1990 to $153 million 1991. Using retail method, not perpetual method. Mark of merchandise up 20%, resulting gross margin 16.7%. Overall margin fell to 15.5%, resulting cost complement of 84.5%. Problem for pricing and costing inventory. Inventory complication contain fraudulent journal entries. There is no explanation or supporting documents. Account names, AR inventory contra or cookies to inflate inventory and earnings. Bucket accounts allocated a portion back to individual store. General ledgers reveal the fraudulent entries. Recorded numerous blowout entries to empty the bucket accounts. Accrued inventory was almost $10 million in 1991. Allocate inventory was $139 million. Unusual adjustment to inventory accounts and zero balance drew little attention from auditor. And then roll forward inventory between inventory account date and balance sheet date. That is large increase in ending book inventory balance. First, lower inventory prior to the physical inventory. Second, build up big 4th of July holiday demand. Last portion of spike inventory was due to fraud. 6. Inadequate internal audit function. Moniz was a member of the audit committee. It appeared conflict of interest because Moniz was board of director and then he was also audit committee. Different function between management and the controller. CFO override internal audit function. The governance did not function to oversee management's actions. Conclusion: lifestyle changes are early warning signs of frauds. Collusions among upper management destroys internal control system within the company. Inadequate business strategy and high-pressure competition make the company's profitability suffer in the long term. Business planning and control through operational excellence by implementing information technology, that is point of sales and ERP. Internal audit function has to function as an oversight board by maintaining independency and objectivity from management. Public accounting firm is expected to deliver good quality audit opinions which are free of material misstatement for decision making. Lesson learned: hands-off management style brings the company into troubles, therefore needs to implement a counter-check balance and proper reward and punishment. Reckless behavior of public accounting firm without concerning the early warning sign and red flags brings disaster to the result of audit works, which will suffer the public trust to the auditing profession.